Can Vietnam transition from a developing market to become the regional financial gateway? Through the previous sections, I have analyzed the institutional foundation, the role of the rule of law, along with the importance of policy and discipline in building an international financial center in Vietnam. But a larger question still lies ahead. A financial center does not exist solely through internal reform. It must be positioned within the global financial power structure. It must be recognized by the international market. And it must have enough credibility for cross-border capital flows to be willing to shift. The next stage is no longer about building foundations. It is about entering strategic competition. From episode 16 to episode 20, I will analyze how Vietnam can position itself within the global financial system, among centers that have existed for decades. This is a story about strategic positioning, about integration, and about the ability to become a substantial international financial center in Vietnam. Not just in name only. I begin with a fundamental question: become a free financial center or wither away? Episode 16. You want financial freedom? So do criminals. A free financial center is a symbol of prosperity. But for the underworld, it is also an opportunity. Without a strict cash flow control system, an IFC does not become a gateway for international capital. It becomes a cross-border money laundering machine. And the price to be paid does not come from criminals. It comes from the global financial community. Once placed on the gray list of the Financial Action Task Force, FATF, your banking system is not immediately banned, but it is suspected. And in international finance, suspicion is more dangerous than punishment. Correspondent banks increase inspections. Compliance costs skyrocket. Remittance times lengthen. Partners request additional documentation. Investment funds delay disbursements. Clean capital does not like environments of legal risk. They have too many other options. Financial history has witnessed many regions that once grew rapidly thanks to easy money flows. Initially, the growth was impressive. Service fees rose. Real estate boomed. Tax revenues came in fast. Lessons from centers that lost their reputation. But when labeled as a tax haven or a money laundering hotspot, the ecosystem changes instantly. Global banks like JP Morgan Chase or HSBC do not leave because they hate profit. They leave because legal risks can collapse an entire corporation. When the clean sharks leave, what remains are only entities willing to trade reputation for short-term gain. An IFC cannot survive on dirty money. Dirty money does not create trust. It creates volatility. The anti-money laundering (AML) system must be built according to the 40 recommendations of the FATF. No exceptions. No flexibility according to circumstances. AML is not a procedure. It is survival infrastructure. A serious financial center must ensure enhanced customer due diligence (KYC), publicity and verification of ultimate beneficial owners (UBO), real-time tracking of unusual transactions, automated suspicious transaction reporting. I do not just ask, where does the money come from? I must be able to answer, who truly controls that money flow? In the context of Vietnam, where habits of using cash and holding assets in others' names still exist, this is a fatal weakness if not handled thoroughly. An IFC cannot operate on a culture of trusting each other is enough. Within the IFC, if the source of funds cannot prove its legality, the account must be suspended immediately. Not 5 days, not 24 hours, almost instantaneously. That is not harshness. That is a self-defense mechanism. The solution does not lie in increasing paperwork. The solution lies in technological architecture. Technology is the invisible police layer. An independent financial intelligence unit, FIU, needs to be placed right at the core of IFC operations. This agency does not operate with paper files. They operate with data. Transaction behavior analysis using AI. Detection of smurfing patterns. Cross-border data matching. Connection to international databases. Blockchain can be used as a tracking tool, especially in cross-border transactions and digital assets, not to show off technology, but to create uneditable transparency. Every large business participating in the IFC must accept periodic review processes. No exceptions for big names. Strict control does not drive away quality customers. It drives away those who do not meet the standards. Pension funds worth hundreds of billions of dollars. Multilateral development institutions. International banks. They only pour money into places where they know they do not have to sit at the same table with financial criminals. A single dirty coin can bring short-term benefits. But it is the tinder for a long-term crisis. The price of laxity. Being placed on an international watch list means national borrowing costs increase. Credit ratings face pressure. Domestic businesses are strictly inspected abroad. The banking system loses the ability to connect smoothly. Then, the problem is no longer the IFC. It becomes a problem for the entire economy. A clean financial center does not just protect foreign investors. It protects domestic businesses. Protects the banking system. Protects national prestige. Closing. A sustainable IFC is not the most lenient place. It is the most disciplined place. Clean is a condition, not a choice. If you loosen control for immediate benefits, you are placing a bomb under your own foundation. When it explodes, not only are the criminals swept away, but legitimate investors also withdraw. Global finance operates on verifiable trust. To become a true financial center, you must accept one principle. There is no room for money of unknown origin. No exceptions for relationships. No flexibility in international standards. A clean financial center is a long-living financial center. And in this game, living long is more important than growing fast. What determines global financial prestige? Episode 17. Wealth does not equate to victory. Japan is the third largest economy in the world. They have technology. They have infrastructure. They have multinational corporations. They have massive foreign exchange reserves. So why has Tokyo never surpassed Singapore or Hong Kong to become the financial capital of Asia? The answer does not lie in money. It lies in the structure of thought. After the 1980s, Japan was at the peak of financial power. Their banks dominated global rankings. The stock market boomed. Real estate prices rose dizzyingly. The paradox of the giant. But the bubble burst. 3 lost decades began. Meanwhile, Singapore and Hong Kong did not have large domestic scales. They did not have massive consumer markets. But they had something more strategic: the ability to become a platform for the world to use. Tokyo remains the financial center of Japan. But it did not become the financial center of the world. This is the vital difference. Global finance operates by a common set of rules. Psychological and linguistic barriers. English language. Contractual thinking. Predictable legal standards. Japan has a strong legal system. But most of it was built for the domestic market. Administrative procedures are complex. Corporate culture is conservative. The governance structure prioritizes protecting traditional businesses over encouraging disruptive models. Global finance does not like invisible barriers. They do not want to waste time decoding culture. If an investment fund has to hire 3 layers of consultants just to understand local processes, they will move elsewhere. Singapore understands that. They turned themselves into a cultural buffer zone. The court system uses English. International commercial arbitration operates transparently. Disputes are handled according to global commercial logic. Meanwhile, Tokyo remains more national than international. The biggest mistake of a rising economy is believing we are strong enough, the world will automatically adjust to us. Lessons for rising economies. The reality is the opposite. International finance does not adjust to individual countries. It adjusts to common standards. If you require foreign experts to learn how to operate according to local administrative processes, to adapt to a ask-give culture, to accept ambiguous flexibility in legal interpretation, they will leave. Not because they lack patience, but because they have other choices. Japan has a large domestic capital market, strong banks, leading export businesses. Domestic wealth does not create global attractiveness. But a global IFC does not live off the domestic market. It lives off the ability for cross-border connection. Singapore is much smaller, but they opened up completely to foreign banks. Hong Kong became the bridge between China and the world. Tokyo, conversely, mainly serves the domestic ecosystem. That is not an economic failure, but it is a strategic limit. A new financial center cannot be an upgraded copy of the old system. Solution: liberalize thinking before liberalizing markets. It must be a distinct entity. This requires an executive board with a truly global mindset, accepting international experts in decision-making positions, using English in all core legal documents, an independent arbitration mechanism according to international commercial standards, not to foreignize, but to standardize. If you build an IFC but still require everything to operate according to traditional domestic thinking, you are creating a miniature version of the current system, not a global platform. Japan has lost many years reforming its international financial environment, but the first mover advantage has belonged to others. Emerging economies do not have 30 years to experiment with mistakes. A successful financial center does not just have good laws. It has an open attitude. Open culture is a competitive advantage. Open to foreign talent. Open to new business models. Open to disruptive financial technology. If the fear of losing control outweighs the desire for global competition, the result will be a financial center that exists on paper, but does not become a true destination. You can build towers higher than Tokyo. You can have GDP growing faster. But if the mindset remains closed, money will only visit, then leave. Closing. Wealth does not guarantee victory. Scale does not guarantee status. To play globally, you must accept global rules. In international finance, victory belongs to the place where legal language is accessible, transparency standards are clear, international management mindset prevails, culture is ready to adapt. Tokyo is a lesson that domestic economic strength does not automatically translate into global financial power. To master the game, you must accept that the playground is not your own. And the hardest thing is not building infrastructure. It is opening the mind. Can capital flow in without trust in the institution? Episode 18. Money is not loyal. It is only loyal to safety. International capital flows have no emotional memory. They are not grateful. They do not wait. They come for profit. And they leave because of fear. Just a single rumor of political instability. Just a single major bankruptcy handled without transparency. Just a single doubt about bank liquidity. Billions of USD can vanish from the system with just one click. Are you ready for a bank run on a digital scale? In finance, the most important asset is not on the balance sheet. It lies in market perception. Trust, the most fragile asset. The 1997 Asian financial crisis is a clear testament. When investors began to doubt the true level of bad debt in the banking system, the flight happened simultaneously. No one wanted to be the last person to leave the ship. What triggers a crisis is not always the numbers. It is the lack of transparency regarding those numbers. When information is unclear, the market will automatically assume the worst. In an IFC, risk does not only lie with the banks. It lies with major corporations, central financial institutions, and entities deemed too big to fail. If a pillar enterprise experiences an accounting scandal or insolvency that is not handled publicly, the problem is no longer about one company. It becomes a crisis of systemic trust. Modern finance operates at the speed of algorithms. Investment funds use automated warning systems. Risk models update by the minute. Cash flow and crowd reflexes. When an abnormal indicator appears, capital can be withdrawn immediately. There are no more scenes of lines of people withdrawing money in front of bank doors as in the last century. Today, a click can replace an entire crowd. That is why liquidity risk management cannot rely on traditional experience. It must rely on real-time data. A sustainable financial center must have hard infrastructure, defense mechanisms, a sufficiently large liquidity reserve fund, circuit breaker mechanisms on the exchange, strict capital adequacy ratio regulations, a clear deposit insurance system. But this is only the first layer of protection. Circuit breakers can temporarily suspend trading. Liquidity funds can inject short-term capital. But if trust is broken, technical measures only buy time, they cannot reverse the psychology. The decisive factor lies in how information is handled. Soft infrastructure, ruthless transparency. When an incident occurs, the regulatory agency must be the first spokesperson, not social media. Not rumors. Information must be accurate, timely, accompanied by a clear action plan. In the digital world, concealment is a suicide strategy. Bad news spreads faster than official responses. If the regulatory agency remains silent, the market will write its own story. And that story is usually worse than the truth. A modern IFC needs a 24/7 systemic risk monitoring center. AI-level risk management. Not only monitoring the domestic market, but also global interest rate fluctuations, ETF fund flows, geopolitical risks, international liquidity events. The lesson from the collapse of Lehman Brothers in 2008 shows, when a major link breaks without a clear handling plan, the domino effect spreads globally. Liquidity forecasting algorithms, periodic stress test models, and extreme scenario analysis must become the norm. But technology is only a tool. The core factor is market discipline. Large organizations participating in the IFC must accept living wills, mechanisms, plans for an orderly restructuring or liquidation if a crisis occurs. Living wills, no safe zones. This sends a clear signal. No business is granted a default bailout. No privileges because of scale. The market is only sustainable when every entity understands that they must be responsible for their own risks. If investors believe that the government will save everyone with tax money, market discipline will vanish. And when discipline vanishes, risks accumulate. Trust does not come from slogans. It comes from repeated actions. How is trust built? Publishing transparent reports, conducting independent audits, publicly handling violations, punishing violations without selection. A financial center that cleans itself is more attractive than a financial center that shields its mistakes. Money stays where it is protected by the truth. Closing. You can build modern infrastructure. You can promote international status. A non-compromising choice. But if, in a moment of crisis, you choose ambiguity over transparency, the market will respond with flight. Money does not stay because of promises. It stays because the system has the capacity to withstand shocks and tell the truth. If you want capital flows to commit long-term, you must accept a simple principle. Transparency is not a communication strategy. It is a survival mechanism. And in global finance, survival is always more important than short-term growth. Is Vietnam ready for the global financial competition? Episode 19. Exchange rates are not numbers. They are a battlefield. You look at the electronic board and see a flashing number. But in the world of global finance, exchange rates are a type of weapon. Just one coordinated short-selling wave from international hedge funds, and the local currency can lose tens of % of its value in a very short time. When that happens, assets denominated in the local currency within the IFC will have their real value eroded. Foreign currency debt swells, panic spreads. The question is not, will it happen? The question is, when it happens, do you have enough layers of defense? In 1992, George Soros and hedge funds bet against the British pound. Lessons from history. When the market tests the state. The result. The Bank of England was forced to withdraw from the European exchange rate mechanism. This event is remembered as Black Wednesday. In 1997, the crisis began with the Thai baht. The fixed exchange rate could not hold up against market pressure. When trust in the ability to protect the exchange rate declined, capital flows withdrew en masse. The lesson is very clear. You cannot want to open up finance while also wanting to fix the exchange rate rigidly without paying a price. The market always tests the consistency of policy. If the policy is not sustainable, They will find a way to break it. An IFC that wants to attract international capital must accept the mobility of money flows. But free money flows mean higher exchange rate volatility. The paradox of financial openness. This is an unavoidable contradiction. If you protect the exchange rate at all costs, you will have to use foreign exchange reserves continuously. But reserves are not infinite. When the market realizes you do not have enough ammunition, the attack will grow stronger. If you float completely without defense tools, domestic businesses and investors will suffer a major shock. Therefore, the problem is not choosing between fixed or floating. The problem is designing the appropriate structure. A modern IFC can operate according to a risk layering mechanism. 2 market layers, 1 armor layer. Within the IFC framework, trading in strong currencies, or the local currency is internationalized with a flexible exchange rate mechanism. This creates a buffer zone between the international financial market and the domestic civil market. You cannot place the entire economy on the same front line as global hedge funds. Designing the correct structure will help absorb shocks without widespread transmission. The most effective defensive weapon is not administrative intervention. It is the derivatives market. Derivative tools, the true shield. Futures contracts, options, currency swaps. These are all tools for businesses to protect themselves against exchange rate fluctuations. If a business borrows in USD but has revenue in VND, they must have the ability to lock in the exchange rate through hedging. If the cost of risk prevention is too high or the derivatives market is underdeveloped, systemic risk will accumulate. A strong IFC must have high liquidity futures and options markets, a secure clearing system, transparent margin requirements, strict monitoring of counterparty risk. When businesses know how to protect themselves, an exchange rate shock will not turn into a liquidity crisis. Violent intervention using foreign exchange reserves may be effective in the short term. But if abused, it sends a signal that the market is being controlled by orders rather than mechanisms. The role of the state, setting the rules, not holding the sword. The state should establish a clear legal framework for foreign exchange transactions, ensure transparency in monetary policy, provide periodic data on reserves and liquidity. The market fears surprise the most. When policy is consistent and predictable, the incentive for speculative attacks will decrease. Financial freedom does not equate to absolute stability. It equates to the ability to absorb fluctuations. Volatility is the price of freedom. A mature IFC does not try to eliminate volatility. It builds a system to live with volatility. Businesses have hedging. Banks have foreign exchange risk management. Investors understand the level of risk. Regulatory agencies have response scenarios. When all subjects are prepared, the system becomes resilient. Closing. In currency wars, there is no room for naivety. Do not enter the game if you do not understand the rules. If you open an IFC without a sufficiently deep derivatives market, without a flexible exchange rate mechanism, without policy transparency, you are not attracting capital. You are inviting a challenge. The exchange rate can be an offensive weapon, but it can also be a balancing tool if designed correctly. Financial freedom always comes with volatility. The question is, do you build a wall to resist the wind? Or do you learn how to design a structure that can withstand the storm? In global finance, the survivor is not the strongest. It is the one who clearly understands the opponent's weapons and prepares before the gunfire rings out. What will determine the long-term financial future of Vietnam? Episode 20. Cash flow arrives like a favor, but it leaves like a storm. Fast-flowing money always creates a sense of victory. Indices rise. Liquidity explodes. Real estate escalates. New names appear on the wealth lists. But hot money is not a foundation. It is a lever. And a lever, if used wrongly, will crush the very system benefiting from it. Hot money is like a Trojan horse. It enters the city looking harmless. But when the doors swing open, the consequences can destroy the entire financial structure. History shows that emerging markets usually collapse not because of a lack of capital, but because of too much short-term capital. The liquidity trap of emerging markets. When interest rates in the United States rise, global cash flows immediately reallocate. Speculative capital returns to places seen as safer. What happened during the Asian financial crisis in the late 1990s shows. When capital flows withdraw simultaneously, domestic liquidity evaporates in weeks. The dangerous thing is that asset bubbles do not burst when money flows in. They burst when money withdraws. A stock market that increases by 40% thanks to short-term foreign capital is not a sign of health. It can be a risk indicator. Because short-term capital has no loyalty. It only has a profit objective. Not all international capital flows are dangerous. Distinguishing long-term capital and speculative capital. Pension funds, insurance funds, sovereign wealth funds, they have a 10 to 20-year vision. They seek stability, not surfing waves. In contrast, short-term speculative capital operates on weekly or monthly cycles. They take advantage of interest rate differentials, exchange rate fluctuations, and psychological volatility. A sustainable IFC must know how to categorize capital flows. You cannot welcome everyone with the same policy. Applying a Tobin tax, a small tax on short-term transactions, is an option once proposed to reduce purely speculative incentives. Control tools. Not closing the door, but selecting. Additionally, a mechanism based on the residency time of the capital flow can be designed. Long-term investment capital receives tax incentives. Capital withdrawn within an extremely short time incurs higher fees. Restricting excessive leverage in short-term trading. The goal is not prohibition. The goal is to adjust incentives. If the post-fee profit of short-term speculation is no longer attractive, the money will select itself. A common mistake for policymakers is to look at rising indices and assume the market is healthy. Early warning system, monitoring structure. Not just indices. An index does not reveal the essence of cash flow. A modern monitoring system must analyze the ratio of short-term trading versus long-term investment, the level of leverage used, concentration of capital flows by industry sector, cyclical foreign capital inflows and outflows. Building a cash flow health index using AI can help forecast withdrawal trends 24 to 48 hours in advance. Not for administrative control, but to prepare liquidity. Markets do not collapse because of volatility. They collapse because of a lack of preparation for volatility. A strong IFC needs long-term anchors. Creating anchors to hold the ship. International pension funds, sovereign wealth funds, institutional investors with multi-year allocation strategies. When the investor structure leans toward long-term institutions, volatility will be better absorbed. If the market is primarily T-plus surfing transactions, just a small psychological shock is enough to cause a domino effect. High liquidity does not equate to stability. Stability comes from the structure of the cash flow. Hot money often finds its way to places with high yields and strong price growth expectations, especially stocks and real estate. The risk of asset bubbles. When asset prices rise faster than the real growth rate of the economy, a bubble forms. Paper billionaires appear. Banks expand credit based on appreciating collateral. Businesses borrow more because of a feeling of wealth. But when capital flows reverse and assets depreciate, the debt remains intact. That is the moment the system must pay the price for its previous excitement. Hot money can make short-term numbers look good, but it does not build a foundation. Closing. Selection is responsibility. A mature financial center does not chase speed. It prioritizes the quality of cash flow. Financial freedom does not mean unconditional openness. It means designing smart rules of the game. If you let the glamour of liquidity blind you to structural risks, you are creating your own weakness. Choose investors who accompany a long-term strategy, or accept being swept away by the withdrawal rhythm of others. In global finance, you cannot control cash flow, but you can control the structure that receives it. And the right structure will decide whether the flood becomes a driving force for growth or becomes a deluge that sweeps everything away.